Welcome everyone to our webinar. Arthur, Ken, how's it going? Welcome to the webinar. We've got quite a few people joining in. Just throwing out a shout out. Hi, Russ, Johan, Kenneth, Arthur, Miriam, Gary. We've got a lot of people coming in. If you have a microphone and would like to say hello, we'd love to hear from you. And it looks like we do have a mix of some members and some investors who are interested in joining us. So welcome. How's it going, John? And I do want to make sure everyone knows you also have a chat box. So if you don't want to use microphone to talk, feel free to use the chat box. Goal of today's webinar is to teach you our strategy, how it works, when it breaks, and how we're going to adopt the strategy when the big macro picture changes here. It's probably a couple of years out, but the trade war could certainly escalate or reduce the timeline. All right, guys, well, we'll give it another minute or two for a few more people to join us, and then we'll get this going. I also have a recording of the webinar that will go out Saturday. So this is actually a slimmed down version of our $10,000 boot camp, the first module. So what you're not going to get today is a big sales pitch. You're going to get the strategy, how it works, the pros, the cons, and how I anticipate the markets developing here. So thanks for joining us live. And if anyone does have a microphone and wants to say hello and tell us where you're calling in from, or if you've been following any trades, we'd love to hear from you. And if not, we'll get started in a minute. Gary, how's it going? I see you've got your microphone unmuted.
Does it work?
Yes, sir.
I've never used it. So, I got a question about, does this trading options work in IRA accounts?
Absolutely. The only kind of account you'll have trouble with would be a 401k because they usually, they have their own little special instruments they make you trade, and it's not normally something like the SPY and the TLT. But for just a normal, where do you have your retirement account hosted at right now?
Fidelity.
Oh yeah, absolutely.
So is there any things you have to watch? I mean, I've read small things about it saying you have to like do some kind of covered call or covered something.
Sure. Yeah. So
you can't just do an option. You've got to buy the stock and do an option against it or something, or with it.
Yeah, we're taking advantage of having larger capital than most investors. So our typical investor who is attracted to our program, they have at least most of our clients have at least $300,000 they're following the program with, but many have seven-figure portfolios. So you're going to find this is the most boring, safe, conservative strategy on the planet. We take what's already a pretty boring strategy, which is simply just overlapping a equity bond portfolio, which if you look back in the last 40 years was a very low volatility, consistent returning strategy. And that'd be if you just were to buy and hold those assets. You could have dramatically reduced your volatility in the 08 crash, the dot-com bubble, really every recession we've had over the last 40 years. But in this presentation, we're going to talk about why that magic little combo is probably coming to an end and why. And you'll be able to see without any question why that strategy is most likely going to break down within the next 24 months or less. and why you're really going to want the options to be able to flip the strategy upside down and generate profits when times get a little tougher than they are now. And I did see another fellow just join, Jim Locke. Welcome to the webinar. We're about to get going. If you have a microphone and you'd like to say hello, we'd love to hear from you. Now, do you have a cash account too, Gary, or are you just trying to trade your retirement account?
Basically just a retirement account.
Okay, sure. All right, guys, great. Well, I'm gonna go ahead and get the presentation rolling here. And we got, hey, Jerry, how's it going?
Great. How you doing, buddy?
Doing good.
Good Thanksgiving?
Yeah, we had a great Thanksgiving. Guys, Jerry's been on the program since when, February?
Yeah.
So.
Yeah, I've been following you before then, too.
Yeah, he's been following me for quite some time, so that's good. Probably you've attended more webinars than anyone else, so thanks for your showing up to the bat every week.
You're welcome. I like your good information, buddy.
Excellent. All right, guys. Well, I'm going to go ahead and get this show on the road, and we will come back for questions. Now, I actually have everyone unmuted, so feel free to interrupt me at any time. If you have a question, probably someone else has the same question, so please feel free to interrupt me at any time. Again, this is a little piece of our $10,000 boot camp. It's designed to give you the big picture, how the strategy works, why it works, take away all the magic, of these returns so you can really understand the philosophy behind it. And then more importantly, what's going to make this stop working at some point in the future, which I'm estimating is about 24 months away at the longest. And that's where your strategy that most financial institutions rely on, which is being able to have a stock and bond portfolio protecting one another, breaks down. All right, guys, I'll go ahead and get started. The easy way to predict markets and generate safe income. Our program delivers daily income trade alerts at noon Eastern. Now, that doesn't mean you have to collect the income and spend it. You can reinvest it. So if you've got your money in a retirement account like Gary, this is just a safe way to grow your portfolio with low volatility. This is the current allocation of capital, and most likely will not be touched for at least 2 years in terms of how much shares we have in each ETF. We trade the SPY ETF Monday, Wednesday, Friday with 100 shares. The Emerging Markets ETF Tuesday with 200 shares. The TLT ETF and GDX ETF on Thursday with 200 shares each. Now, this is about a 54% equity position, 38% bond position, and 8% gold position. But once we add in the option callers, it can dramatically change the real risk profile, which I'll show you guys in a minute. Our goal is to generate a 1% return per month, and our average return in the past 12 months is 1.25. Now, do we always get 1%? No, sometimes we're above, sometimes we're below. A lot of people ask me, do you have a more aggressive strategy? The answer is no, but your broker-dealer is able to borrow at extremely low rates and carry on that loan to you at extremely low rates, and they'll give you 2-to-1 buying power. So if you want a little extra boost from our program, I highly recommend taking advantage of every penny they'll give you. And that's because this is an extremely conservative strategy where we already have very low volatility. We've had profits in 11 of the past 12 months, and our largest drawdown in a month is negative 1%. Now, I want to point out that I will be more than happy to have a flat return or a return below 1% if I believe there's a catalyst in the near future that could create a large loss for our strategy. So if the coast is clear, we have a very obvious path forward, I'll be much more inclined to take on a little extra risk and try to beat our 1% return. On the other hand, if I think we are moments away from a catalyst that could be detrimental to the markets, which is in this instance Trump increasing tariffs, I will play it super safe. So a lot of people call me Paranoid Pete or Skeptical Sam. You can come up with whatever nickname you want, but this is the program that's going to play it ultra safe. We've never lost capital over a 90-day period. And our strategy really shines when the S&P 500 is selling off. And that's because when stocks sell off, our option caller, the put option, kicks in. It cuts off all the losses after a certain point on equities. And then we usually have a very wide opportunity to profit from the TLT and GDX traveling higher. So what you can expect with this strategy is we will underperform the S&P 500 when the market's traveling higher, always, 100% of the time. However, when there is a sharp sell-off in equities, our portfolio will not only outperform the S&P 500, it will typically generate a nice profit. And so you can see in December, when we had a 16% crash in equity prices, we returned 1%. In May, out of the blue, we get a 7% sell-off. Our portfolio generated a 2.2% return. In July, our only losing month, I was highly convinced there was a great possibility of Trump increasing tariffs on the trade war. Unfortunately, I was a month early. That was our only month we lost money. We lost 1%. And then I was completely off guard. I thought he was going to kick the can down the road past the election. Surprise, surprise. In August, he increased the tariffs dramatically. Market sold off another 7%. And this time, we weren't even expecting it, and we picked up a 0.8% return. The last several months, I've been very concerned of trade war escalation. So we've had smaller returns, but we've still generated profits. Now, what I want to point out is that we do optimize the options to profit from 3 different market environments that we're currently having to face. The first is an up-in-the-air trade war. One day it's going good, next day it's going bad. We have conflicting messages every half an hour. More importantly is the conditions of the central bank. And at this point in time, they've lowered interest rates 3 times in the last 6 months by 75 basis points. So we have low rates that are traveling lower. The next thing I'm really concerned with is what's going on with inflation, at least the inflation that the Fed measures and uses to determine monetary policy. And from their standpoint, they say it's low, below their 2% target. And they're talking about symmetrically going above the 2% target rate. In fact, the last thing they're worried about is raising rates or inflation. In fact, if you read the latest FOMC minutes, it's 20 pages long. In our boot camp, we went through it in detail. Bottom line is the only thing they're talking about is what's going to happen when they hit 0, because they know that will freak out the bond market. And so the path from 1.75, where we're at now, to 0 is really the end of the rope. And that's when the stock bond strategy will be really facing some challenges. So in this environment, when we have low interest rates, we have low inflation, we have quantitative easing. And in fact, in the past 60 days, we have more quantitative easing than ever before in history. And they're telling us the glass is half full and everything's gravy. So that's clearly a big joke. There's obviously some major losses in the market that they're covering up. That's why we have $300 billion in repo madness currently. Bottom line is we want to be long the SPY, emerging markets, TLT, and relatively long GDX, but with a tight option collar in this environment. This is the bubble up environment. Now, we're not going to change underlying assets. And in a minute, I'll show you how you can act as a landlord and lease out your property to profit from a down move in any of these assets. But if the trade were to escalate while we have low rates, low inflation, and QE, we're going to be short-term, ready to short the SPY in emerging markets and expect appreciation in the TLT and GDX. And again, we use the option callers to generate profits in these different environments. And in a minute, you'll see exactly how those option callers are formed. And then the last strategy that we have to have ready is a de-escalating trade war. We know that Trump really wants a trade deal. There's been no president reelected during a recession. And when we look at China's collapsing numbers, there's a high risk that if this trade war is not at least paused, the entire world will be in a recession by next year. That's why we have all the central banks lowering rates. In fact, you can't find a single time in history that the Fed dropped rates by 75 basis points, and we were not soon followed by a recession. They're very smart. They have teams of PhDs. They're not necessarily going to tell us what's really going on, but their actions speak louder. They've cut rates 3 times, and they're doing massive quantitative easing. So things aren't just all right. So that is why Trump really wants a trade deal at this point in time. But China knows that. They know they can actually cause a recession just by allowing their economy to slow down. It's that big. So it's very tough. We have to go with the news flow. And the biggest news most recently was that Trump signed the Hong Kong bill, which China had been signaling if he were to do that, they may walk away from the trade deal. So we'll see how this all plays out. But if they do come to terms, which is what they said they were doing back on October 8th with the phase 1 trade deal, well, that's when you want to be long stocks and short bonds and gold, again, for a short period of time, because we know the big picture is all of these assets are going to be bubbling up when interest rates go towards 0, and the central bank is bailing out all of the banks with massive quantitative easing. All of a sudden, fundamentals don't matter. All that really matters is you have free money and an increasing balance sheet in all of the major central banks around the world. So let's review the 3 types of option callers. First, we have a bullish loose option caller. With this setup, we're going to allow the options to lose money and the underlying asset to appreciate and generate a profit. So we're selling an out-of-the-money call option, and we're buying an out-of-the-money put. And this way, if something bad were to happen, that were to cause this particular ETF to sell off, the worst case, the maximum loss is $310 per contract or per 100 shares. And in this example, we're looking at the SPY. And that's because we bought the $295 put. It's like having insurance. Imagine not having health insurance at this point in your life. It would be just complete insanity. Well, what about your portfolio right now? What if something bad happens? Do you have any downside protection? And if not, why not? So in this option caller, you can see how we're able to sell an out-of-the-money call option for 33 cents and then turn around and use that to buy downside protection for 46 cents. So the call option we sold almost financed our downside protection for free. And in this example, we want the SPY to travel higher to generate our profit. Now, if we think we have a flat move ahead or a risk of a sell-off, we might consider a tight option caller. This is actually what I've been issuing on the SPY for the last several weeks as we hit my 315 target on the SPY, which may have seemed unbelievable just a month ago, but here we are. And so in this example, we're going to sell a much tighter option caller where we get a bigger premium from the call option. And in this example, we're selling it right at the money for a huge $1.53 credit, which more than pays for the 63 cents for our put. So in this example, we're not expecting the SPY to go up, but we're expecting the call option we sold to generate our profit and pay for our downside protection. And then the final strategy is the most profitable, but it's also the least likely to be issued during this market environment. And that's because when there's free money floating around, most assets are going to bubble up without a catalyst. So in this example, we're going to use a bearish inverted option caller. This is the most clever trade most investors are not aware of whatsoever. And in this example, we can own the asset, sell an in-the-money covered call. So it's trading at 298 in this example. I'm going to go ahead and sell a 297 call. That gives me a huge credit of 219. Now, if I were to just do that and the SPY were to travel lower, I'd still lose money. The next step to generate a profit while owning the SPY and to generate a profit from the downside, I have to turn around and buy an in-the-money put option. So in this example, I've sold the 297 call, which is $1 below the current trading price. That means I'm agreeing to sell my shares for $1 loss, but only because the option buyer is paying me $219. So I actually have about $1.20 profit going into that trade if the market were to travel higher. But I'm not betting on the market going higher when I sell an in-the-money call. I'm betting on it going lower. So I'm turning around and buying a very juicy $300 strike in the money put. And guess what? It costs just about the same as the call option I sold. So if I'm right and the stock does travel lower, the call option generates a profit for me and the put option generates a profit for me. And that profit will be greater than whatever we've lost on the underlying asset. And so in this setup, we have the potential to win $200 or lose a maximum of $100. In all three strategies, we have a maximum risk and a maximum profit at all times. Now, before I go any further, let's take a quick break and make sure we all understand these three strategies and these three settings. Now, since you have your microphone unmuted right now, Gary, would you mind being a guinea pig?
Sure.
All right, so, all right, tell me what you see on this screen. If the trade war is up in the air, are we bullish or bearish on the SPY?
If it's up in the air, I'd say neutral.
Oh, on my chart.
Well, it says up in the air, but
Next to the SPY, you see a plus or a minus?
plus.
Okay, so that's all that's trying to illustrate is that we're going to be long the SPY if the trade war is up in the air and we have low rates, low inflation, and quantitative easing. And that's been extremely profitable for us since this phase one trade deal came out. Okay, what if the trade war is escalating? What do you see in this chart or this diagram?
Then we're down on the spiders.
And then we're long on what asset class?
Gold and bonds.
Correct? And if we have a serious de-escalation in the trade war?
We're bullish on the spiders and EM. Negative on.
Yep, and negative on bonds and gold, correct?
Right.
Okay, now in this diagram, does this make sense when I say we're going to sell an out-of-the-money call and buy an out-of-the-money put? Have you ever traded option callers, by the way?
No.
Okay, have you ever traded options?
No.
Oh, okay, no problem. I'll walk you guys through this. Let's see what else we have on here. Does anyone have any questions? We got some more people in here. Johan, welcome. Okay, so if we sell a call option, that means we're agreeing to sell our lot of 100 shares at a certain strike price. So I'm selling them at the 301 call, and in this screenshot, they were worth $298. So I'm agreeing to sell them for a $3 profit. And the option buyer had to pay me 33 cents for the right to do that. So he's probably not going to want to exercise his right unless the SPY goes above 301. But even if it does, all that we miss out on is the profits above 301. We're going to enjoy all the profits all the way up for the next $3. And then the guy who bought the call option starts to benefit. So does that make sense?
Yeah.
Now, if I buy a put option, it's the opposite deal. And typically what you have is relatively poor people like to buy call options. They're trying to speculate and double, triple, quadruple their money, and they don't have the cash to buy 100 shares. On the other side of the deal is someone's writing put options. Now that is not a poor person's hobby. In fact, that's the big banks. And they, from their standpoint, they actually could use an extra 100 shares of the SPY anyways. So they're happy to sit there and do this high probability trade. It's like being an insurance company. So they'll sit there and sell that 295 put for 46 cents all day long. And they don't care. They really don't care if they get assigned because they'll pick up those shares. But here's the catch. If something really bad happens, we've seen the SPY drop $5, $10, $20, $30 in a very short period of time. If we own the 295 put, that means we get to sell our shares to the bank for 295, no matter how low the SPY travels. Doesn't matter. We get 295 a share. They keep the 46 cents, but we paid for it by selling the 301 call. So does this make sense to everybody on the call so far? If you could at least let me know you understand in the chat box if you don't have your mic muted. Just want to make sure we're all clear. Okay, so Jerry understands. Now let me ask you this: who's traded options in here? Jim, John, Myron, Johan. Can you let me know if you've traded options before, and Arthur as well? Now, Gary, you might be a good candidate for our boot camp program if you're new to trading options. So just a heads up. Johan, okay, so great. So if you've never traded options, what I like to say about our boot camp, first of all, it's not just generic materials you've seen anywhere else. It's completely unique content. But second of all, you could sit there and watch the tennis instructor serve the ball all day. That doesn't mean you're necessarily going to be able to serve the ball after watching them. So there's a good 8-week period that it's going to be you serving the ball over and over and over again to really get you prepared and confident. Now, as easy as these trades are, it still seems a little foreign at first until you get used to really all the terminology. But our strategy is very, very repetitive. Okay, let's go to the next screen. So this is called a loose option caller. We're selling out of the money call and we're buying an out of the money put. It's the riskiest strategy we have, but it's still atomic bomb proof. SPY could crash $10, $20, $30. We're only going to lose a maximum of 3, and that's because we sold, or rather purchased, the 295 put. And what's neat about it is we've paid for it for free by selling a call option, which I call taking candy from a baby. We love selling call options, especially out of the money, because they're rarely market moves of that nature. Okay, a neutral tied option. We're selling an at the money call option. So you can see the premium went up considerably. In the last example, I was only able to collect 32 cents. If I sell an at the money call option in this example, I'm able to get $1.53. And that allows me to buy a little bit more valuable put option. So now I can only lose $1. So if I think the market could go flat or up a little bit, but there's a big risk of a turnaround, a sell-off, then I want to use the tight option caller until the sell-off actually begins. This has been the trade we've done over and over and over again on the SPY and have had a tremendous success in the last 8 weeks. Now, again, when we have free money circulating around the world, it's not often that you want to be bearish. We really need a catalyst to use this trade. Now, the obvious catalyst is going to be going from up in the air in the trade war, which is where we're at now, to clear and cut we're either escalating or de-escalating, which we've reviewed which asset you'd want to short or be long. If the trade war escalates, we want to be long bonds and gold and then use this inverted option collar on equities. If I had to bet money, I would bet we're going to be escalating the trade war into the election. Now, we're not trying to get lucky and position our portfolio one way or another before that event happens. So again, currently we're using a mixture of bullish loose collars on the TLT and GDX and neutral tight option collars on the SPY and emerging markets at this point in time. And that's because we just had a major de-escalation in the trade war where bonds and gold sold off, equities rallied harder. We predicted that and did well. So now we're back to the point of either we're up in the air or this thing's going to escalate. Now, does this chart right here make sense to those of you who have traded options in the past? The inverted option collar, do you understand how we can generate a safe profit from a down move? Sorry about the background noise, guys. We've got a snowstorm, a rainstorm here. Jim, does this diagram make sense to you? Would you be able to follow that trade alert and understand how it generates profits and losses? Well, Jerry gets it. I would hope so. He's been on every webinar for the last 52 weeks, so that's great. All right, guys, let's go to the next slide. So those are the three market environments we have to deal with and how we can slightly alter our options to profit. All right, let's look at the big picture, how we predict the moves and why. Okay, so the first thing I'm primarily concerned about is whether the central bank, the Federal Reserve, is buying or selling assets. And we'll see there's a strong correlation to the stock market going up when the Fed is purchasing assets. The second thing I'm most concerned about is whether the Fed is making the cost of money more expensive or less expensive. And they control that through the federal funds rate. And so this is why the strategy may be coming to an end. And a lot of investors are not ready for this. We're not in an 11-year bull market. We're really in a 40-year bull market. And we're in a 40-year bull market because we've been able to go from a 20% interest rate at the effective federal funds rate in 1982. And we've been slowly lowering that all the way down to zero over the past 4 decades. And so a lot of investors I talk to, they're not worried about the next crash because they think it'll be short-lived and rebound back quickly. And I want to point out that in the last 3 recessions, in 92, in 2000, and 2009, the Federal Reserve had to cut rates by over 5% in order to get the economy to rebound. Now, coming into this recession, we're starting at 2.5%, so they can't cut rates like they did in the past. And in fact, typically, they will do rate cutting leading into a crash and then quantitative easing after the crash is around 50%. So they'll let assets crash 50% before they really fire up the printing press. But they didn't do that this time. They've cut rates 75 basis points in 2019, and they've increased the balance sheet by $300 billion, and markets are at all-time highs. And that's because they know they're out of rope. Once we get to zero, that's going to scare the bond market. The bond market gets scared, it will take every other market down with it. And so the last thing we really want to track is inflation. Inflation is supposedly what the Fed will react to increase interest rates. And if we do look at the period from 1955 through 1980, you can see that was a 35-year period of the cost of money going up, and dramatically going up from 1964 through 1980, which you'll see in a moment was a 15-year bear market for stocks and for bonds. So if you were long stocks or bonds from 1965 through 1980, you probably lost almost all of your wealth. And most likely the exact opposite of what we're seeing is about to replay. So we're probably headed towards much higher interest rates as inflation starts to work its way into the economy. Okay, so next chart is to look at the SPY against the TLT. And this is just to visually show you that during the period where the Federal Reserve is able to gradually lower interest rates, we have the opportunity to have both the SPY and TLT go up overall. But what's more important is when the SPY goes down, the TLT pops up. And most notably, look at this jump right here in orange as we had the '08 crisis. Then we had the 2011 scare. This pops up higher. We have another sell-off in 2015. TLT jumps higher. And then most recently, we had the Christmas massacre last Christmas, and it popped up again. Here's a look at your TLT. And what you want to note is that it pretty much just does nothing until there's panic. When there's panic, stocks sell off, TLT jumps higher. This is a zoomed in look. So you can see when the S&P 500 crashed a maximum of 50% in 2009, your TLT jumped up around 40%, offsetting most of the drawdown you would have had in your portfolio. If we look through 2010 and 2012, you can see them weaving up and down. When one goes up, the other goes down, the other goes down, the other goes up. So when you overlap these two strategies, it makes your portfolio much stronger and weatherproof. Now, even when you have an outright bull market, as you see in this example, the TLT did not hurt your returns. In fact, ended up the period with only a negative 2% loss, while your stock portfolio went up 51%. Now, if there had been any serious crash in equity prices, that TLT would have saved the day. So it provided the insurance with very little drawdown. And going into this period of time from 2015 through 2018, we can see the SPY had a relatively flat return, or rather a 33% return. And again, the TLT did not hurt your returns, returned flat. Most recently, we had the crash at the end of the year, last year, and this has caused bonds to spike much higher. Now, this also forced the central banks to go into quantitative easing and lowering interest rates. So now we're seeing both of these assets go up quickly. Also, because of Trump's actions to shake up China and emerging markets, we're seeing currencies around the world lose value against the dollar, forcing these countries to convert their currency into dollars simply to pay their interest on over 11 trillion in US denominated debt that's outside of the United States. Most of these countries, outside of your reserve countries from Japan and the Euro, have seen their currencies lose as much as 90% of their value against the dollar, but most at least 50%. So think about your interest payment doubling, tripling, or quadrupling. And now your only way to pay for it is to print more money in your local currency and convert it into the dollar. So that's the big picture right now. In terms of buying gold or selling gold, when the Fed is buying treasuries and cutting rates, we want to be long. And when they're tightening in any way, shape, or form, we want to be short. The price of gold does not stay still. This puppy loves to fly around, and it really jumps up when we have lowering interest rates, quantitative easing, and then a dash of fear. Also, we can see the gold is not correlated to the bonds exactly. They do travel together in a lot of periods of time, but they do decouple. And so that's important, that every asset in our portfolio is uncorrelated. Now, we were playing spot gold, expecting all this to happen all year. Once it did begin to occur, we've rotated from spot gold into the gold miners, which is GDX. So if we believe spot gold can remain expensive for a long period of time, that means the miners can benefit in an environment where normally they lose money. It's a tough business, and a lot of them were on the verge of going out of business altogether until the recent actions happened in the Fed. So what's in your SPY ETF? It has $262 billion in assets under management, the largest fund in the world, bigger than Ray Dalio's. In fact, when I started this program a year ago, it had 160 billion, so it's grown by $100 billion. Ray Dalio's still stuck at 140 billion, poor guy. It's overweight in technology and financials. And your biggest position is Microsoft 4, Apple 3.8, Amazon 3, Facebook, Berkshire, Google, JP Morgan, Johnson & Johnson. The list goes on. It's 500 companies. It's automatically optimized based on market capitalization. It's a heck of a product. And we don't even count all the dividends they pay as part of our track record. Emerging markets is a ETF that has been bet on by big banks for quite some time. It hasn't delivered the results yet. It's 1,000 different companies that primarily reaches China, South Korea, Taiwan, India, Brazil, South Africa, Russia, Thailand, and Saudi Arabia. It's really Asia minus Japan. And the important companies in that are primarily Alibaba and Tencent, two of the companies in the top 10 in the world. But there's a lot of other huge, massive companies in that ETF. And what's important is that China is growing quite rapidly. They have the biggest population to sell products to, and they've gone from ripping off American products to starting to innovate their own. So they've taken Facebook, developed WeChat and Tatua. Amazon, they've outperformed with Alibaba, Starbucks with Luckin Coffee. They have a phone app called TikTok that's competing with Facebook in terms of downloads. And these guys love to work a lot. So there's good reason to own emerging markets. GDX is 45 gold companies. Most of it is being mined out in Canada, and most of your capital flows to Newmont Gold, which companies like BlackRock primarily own, and then Barrick Gold. If you know Stanley Druckenmiller, his big bet on gold is on that specific company. And what's important is that these are the gold miners who actually can get the capital they need to go dig up that barbaric relic while prices are elevated. They probably have 2 years to accomplish this before we get inflation and this bubble bursts. So I've seen a lot of investors end up owning small cap mining companies who all they're going to do is run investor relation ads and blow your money. They're not going to be mining any gold or generating any profits. So we really live in a world where the biggest companies tend to gobble up all the profits, and it's far too risky to gamble on smaller companies. So if you have any gold mining stocks specifically that aren't on this chart right here, I'd highly recommend getting out and going up the quality chain to GDX, where you'll be better suited. Okay, so when does the long bond stock strategy break down? It really breaks down when there's rising rates, the end of quantitative easing, and those are typically caused by inflation and sometimes deflation. So we're going to take a little look at history now and take note of when did your long stock and bond strategy break down. Now, we did show you how we can profit from down moves in these assets, but it's not usual to end up in a predicament where you're short stocks and bonds at the same time. And that's what the world's really not prepared for. But what's coming, because we're getting towards the bottom of the rope, we can't go below zero on the federal funds rate, so we can't really push this bubble much further. And with no trade war, timeline for me looks about 2 years. That's if they were to cut rates every 3 to 4 months, they could delay this another 2 years, max. If the trade war escalates, they'll be cutting rates very quickly and expediting this timeline. Okay, so we can see there's some horrific periods of return in the Dow over the past 100 years. And really this big 40-year bull market that everyone's become so complacent with is caused by interest rates going from 20% here, and now we're at 1.75. So if you think that we live in a world of quick sell-offs and then you're going to be back to normal and up with maybe a 1-year hold time, I got news for you. Not likely. More likely we're going into a period that's like this, where we had low rates that we're going to rise for about 15 years. So you can see the Dow crashed from 7,500 down to below 2,500, and that 15-year bear market is not something most investors going into retirement are going to want to suffer through. And okay, so there's other periods of low returns, obviously, but the one that really strikes me the most closely is the Cold War with Russia, low rates, and low inflation. That's exactly where we were at right here in 1965. And that's almost identical to the circumstances we're at right now. We have low rates so again, we went from high rates to low rates, high rates to low rates. We've got a Cold War with China currently. At that point in time, we had a Cold War with Russia. There's so many parallels, it's scary. Okay, so what makes the Fed play with monetary policy? Supposedly, it's the CPI index. And you can see inflation's been in this band that's headed lower. Why is it headed lower? Well, we've got this funny thing where we allow corporations to borrow money for free. And so because they're borrowing for free, they're not really concerned about profits. They're concerned about market share. So they can show investors they're growing their market share. And they don't care if they're losing money. Think of Netflix, Uber. The list goes on and on. They're able to borrow, grow their market share, and at the same time print billions and billions of dollars in losses. So how on earth do you get inflation when companies are incentivized to sell products at a loss? Meanwhile, we've got China doing the same thing with their company Huawei. They're subsidizing the industry, trying to put out Apple and Samsung out of business by undercutting the market and selling their goods at a loss. They've quickly become the biggest phone seller in the world. So we're living in a very distorted period of time. But this can only go on for so long. And time throughout history, inflation eventually hits goods and causes problems. And the Fed has a very easy to see response to inflation. So in the blue line, you have inflation. In the red line, you have the cost of money or the federal funds rate. Every time the blue line spikes, that's because their prices are going up, then they will make the cost of money spike dramatically above inflation. It's like clockwork. Every time inflation pops up, they do the same thing. They increase the cost of money. Now, what happens when we cut off the debt? Well, you get your rare negative GDP print. It makes sense. You have positive growth when you increase debt, and you have negative growth when you decrease debt. And so like clockwork, every time they have to hike those rates, we end up with negative GDP and negative returns in the stock market. Also, the treasuries, which is what our TLT is all about, are like a magnet to that federal funds rate. Now, the bond market likes to predict what the Fed will do, but at the end of the day, the Fed makes the call, and that's what drives the stock market and the bond market. Right now, it's quite clear they're going to push rates towards zero. If you read their FOMC minutes, it's 18 pages talking about what on God's green earth are they going to do as they approach the effective lower bound. And they're talking about all kinds of crazy strategies to make the bond market think that's not the end of the rope. Now, here's what's scary. If they were really worried about inflation and we're not manipulating the formula every year to keep it artificially low, the federal funds rate should hike tomorrow. And so we can see there is plenty of inflation that they continue to try to sidestep out of. In this chart, you can see medical costs are up 100% since 2000. In this chart, we can see college tuition is up 170%. In fact, everything the government puts its hands on and subsidizes suddenly has massive inflation. And so over time, even though it sounds like a small increase of cost, 2% adds up. And if we go back to 1990s CPI formula, we should be at 6% plus federal funds rate right now instead of 1.7, and inflation's really closer to 6. You go back to the 1980s metric, and it's much more alarming. Now, inflation's not just at a steady high rate, it's in a uptrend towards 10%. So you need your Paul Volcker to come back in here and jack up rates to 15% if you want to fix the problem. Add to this problem, we've got unemployment at record lows. This means wages are going to start going up, profit margins are going to start going down. So let's go back through history and look at when the Fed loses control of inflation. So now we're looking at World War I. We had some high levels of inflation followed by some deflation. Eventually, this led to the Great Depression. That's where you had your 90% stock crash. And so what I want to point out here is that when we had inflation in World War I, stocks crashed. Get out of World War I, and you can see from 1920, really the 20s, we got the roaring 20s. Inflation's doing all right. 1923, 1.8, 1924, 0.4, 1926, 0.9. And then it starts to lose control and actually deflate in 1927. So what's happening? This is where reparations are being pushed on Germany for World War I. Everybody couldn't get enough money out of Germany, but Germany was already broke. They had to allow their currency to devalue. It went into hyperinflation and eventually caused the Great Depression. And so you can see that horrific stock crash from 1930 to the mid-1930s, going from 5,500 down to something like, I think it hit like 450 or something insane. This is what Ray Dalio likes to compare the current situation to. And you could certainly see a lot of parallels, but I like to compare the Cold War better. So going into the Cold War, once again, we had low inflation for decades. We had 1945 through 1965. Inflation bobbled around between 0 and 1%. We had a few oddball prints of 14 and 7, but mostly inflation was under control. And what did you get? A tremendous stock market rally. But suddenly we can't have rates this low for any longer because inflation's coming. Look what happens. Paul Volcker slowly but surely tries to get inflation out of the economy. And we end up with 20% interest rates over a period of 15 years. From 1965 to 1980 was a general period of increasing interest rates, which was negative for stocks and bonds. This is exactly what I see happening in the next several decades and what most investors are not prepared for. Now, what happened after he did make the cost of money 20%? Well, you didn't have much malinvestment. Everybody's making smart business decisions, plenty of bankruptcies. It was a fresh start. And from this period, we have Alan Greenspan come in and lower interest rates. And we had lowered inflation and a heck of a stock market. From 1982, you got, and really until current, we've been able to enjoy this long bull market because rates have been steadily traveling lower. So you can see his policy. He did hike it up a couple times, but not much. Overall, he just lowered rates. And during this period, the world has assumed so much debt, it's not even funny. Now the market's hypersensitive to any inflation risk and any change of rates. If you saw what they tried to do in the last 2018, they tried to hike rates up, and we had 98% of all assets crash by the end of the year. And so now we can see just a small inflation rise in 2000 and in 2008. marks the start of a major sell-off in markets. Now they were still at a higher rate, so they could still save the day. They could still lower rates by at least 5% in both of these cases, with Ben Bernanke and Janet Yellen. But during the period of 2010 through current, with money essentially free, it's been more bad debt issued than ever before in history, which brings us to current. From 2016 through 2018, they tried to slowly but surely hike those rates up so they could fight the next recession. But alas, markets did not like it. They crashed into October through December of last year, and they immediately went back to quantitative easing and massive money printing. And now they don't have 5% to cut. They have 1.7. So they're trying to use their ammo now to stop the fire before it begins. And we can see the stock market went from 80 to 300 over the last decade. So is it time to play it safe and protect what you've earned? Probably. So what do we see coming down the pipeline here? Well, probably some trade war, probably some tax cuts, probably some impeachment fun. And we're about to go into what I predict will happen in the next several years, but I do want to take a quick break and note that we do have a Black Friday special, 40% off, plus 1 free month in our $10,000 boot camp. 2 spots left. Call Dean at 505-322-7515 to grab that special deal today. Okay, so how do we pop these bubbles? I'm not just talking about stocks go down, bonds go up, bonds go down, stocks go up. We're talking about how does the overall bubble pop? Okay, so here we are in current conditions, low rates, low inflation, quantitative easing. I'd say trade war is up in the air. It's not escalating, it's not de-escalating, and impeachment really hasn't scared anyone yet. So overall, this is where we're long all 4 assets. We keep printing too much money, eventually you get rising inflation. That's going to be the signal for a sell-off in bonds and to start getting ready to take profits on the SPY, emerging markets, and gold. Eventually, your bond yield gets too high. And in that period, you can see money flow out of stocks to treasuries that have a high yield. And really, if you just look at October of 2018, when the 10-year treasury hit 3%, that's hard to beat. The bank looks at that, they say inflation's below 2, the yield on that's 3, that's a guaranteed profit of 1%. They're gonna leverage up on that, sell assets to leverage up on that, and lock in a guaranteed 10 years of profit. So that's how we get the initial wobble between the two. And then eventually you have, in all of my outcomes, rising rates because of rising inflation. And that's where we end up short all 4 asset classes: SPY, emerging markets, TLT, and GDX. So just look at what happened in 2018 when they tried to raise rates. Every single asset sold off. Eventually, they get the inflation out of the economy. There's bankruptcies, and the cost of capital has gone up considerably. And that's what we call the Great Reset, and that's where you get back to a clean slate. And the expectation would be for rates to slowly travel lower, and eventually for QE to begin once again. And that's back to your Warren Buffett strategy. Now, if I had to bet, I would predict that there will be pressure applied to the markets in the 2020 calendar year going into election. So if we have an escalating trade war, first we're going to expect a sell-off in equities and be long stock, bonds and gold. As we have rising inflation and still quantitative easing, that's going to expedite the whole procedure. Now all of a sudden you're going to be short your bonds, as the expectation for the federal funds rate is going to be to travel higher, and you want to get ready to take profits on your SPY, emerging markets, and gold. Bonds can only fall so low before they become too attractive. As soon as the yield on the bond is above the expected inflation rate, money will pour into your bonds. And then we end up again with rising interest rates and rising inflation. This is where you get your double whammy. And this is really what most investors should be scared of, is the Fed is forced to raise rates because there's inflation, and we're doing it in a period of turmoil. And finally, you get your high interest rates, the expectation for QE, and we've had another reset. All right, guys, so that's really how our strategy works, why it works, and how it would break. At this point in time, I'd love to. Okay, John says, I think your system is good, but out of my capital means, have you ever used a LEAP stock replacement? No, yeah, our strategy doesn't work with LEAP options, I'm afraid. Oh, that's a common question. Now, if you did want to just do the emerging markets with the TLT, you could trade it with a lot less capital and still have the very similar risk allocation. So you'd need, for that, you'd need $14,000 to have 100 shares of the TLT. And then you'd want to put an equal amount of capital either into emerging markets or the QQQ, which are both cheaper to get a lot of 100 shares. Do you have access to 30K? So yeah, John, I mean, that's what I would do, is maybe replace the SPY with the QQQ. And then you could take a very similar trade, or if you wanted to be exactly following my alerts, you could just take the Tuesday emerging market trade and then the Thursday TLT, leave out gold. And then you can have very close to the same returns with less capital. So I can have Dean reach out to you to talk about how that could work if you want. Gary, any questions? Oh, Dean, let me get you unmuted. Sorry, Dean.
Hey, Jason, how's it going?
Going good.
Nice, nice. Hey, Johan, are you still on the webinar, bud?
I think he hopped off just a minute ago.
Okay, gotcha.
Kind of got loud for a little bit with the rainstorm right there.
Yeah, the weather's been wild. Well, cool. And yeah, folks, go ahead and give me a call if you want to reserve one of those 2 spots left. I know we have a call set up after with another investor, so it'll probably be one. But fantastic day to jump in. Not only will you get 40% off, but you're going to get access to that boot camp for an entire month for free. So really cool little Black Friday special we got going, and we'll get you in at a 40% discount. And if you've already made the cost of the membership during the trial, give me a call and we'll get you started.
See, Jim, you have any questions, or Arthur? All right, guys. Well, I really appreciate everyone's time, and hopefully you found some value in this presentation and a little bit of guidance towards what to expect from the markets moving forward here.
Thank you, folks. Appreciate your time and attention. We understand that time is the only commodity that we can't purchase, so we absolutely appreciate yours.
Thank you.
Thanks, guys. Thanks, Jason.